We're flipping the compliance conversation on its head. So whether you're a $500 million community financial institution or a global institution, the challenge is the same. How do you turn compliance from a cost center into a revenue engine? So despite millions and billions spent on AML and false positive rates that can reach 95 to 99%, the path forward is shifting from institution level trust to transaction level verification through know your customer's customer without whipping out your core. So excited. Our guest today will show us how this KYCC approach enables growth and how the same capabilities that help you bank fintechs can extend to correspondent banking, widening low cost deposits and fee income, and in many cases, potentially growing deposits by 20 to 30% while still lowering costs. So if compliance only shows up as a cost, you're really leaving money on the table. Really excited to have these two joining us today. Guys, do you want to step in, tell everybody a little bit about who you are and the work you're doing in the space?
Yeah, sure. Hi, I'm Sanjiv Sanghvi, and I am a board member for a fintech that you're going to learn a little bit more about today. But I spent the bulk of my career working for Wells Fargo, where I worked for 30 years and spent a lot of that in running our treasury management business, running our global banking business, and running our commercial banking business. And then since retiring, I've also spent a little bit of time as a board member on a community bank.
Excellent. And I'm Stephen Coburn, founder and CEO of Avalo and Avalo Labs. And we focus on providing technology and solutions for banks who are looking to engage in providing services to fintechs, as well as correspondent banks, money transmitters, any type of client where you're providing payment services, not just to that client, but that client's customer.
Great. Thanks for introducing yourselves. And we can just jump right into things here. So I want to ask you both a question. What's one compliance myth you'd happily retire? Sanjiv, if you want to go first.
Yeah, sure. So I think the big one for me, and it's particularly true for line businesses, people that are working on the line, is they tend to believe that once onboarding is done, the line's work is done. And then it all sits with the compliance team or other people to do monitoring of the activity. And I think what we've learned over the last 15 years is that the expectations of the amount of engagement our line people have to have, even in those treasury management or depository only relationships, remains really steadfast. And I think I'd love to end that one right.
Yeah. Steve, what about you?
I still think that there's some challenges, right, with the culture of compliance. And banks have really been pushing for the last 20 years to create a better culture of compliance within, not just the compliance teams, of course, but all across the lines. And there still seems to be some bankers out there that believe, hey, some AML duties belong to the compliance team. And I really think that, boils down to, okay, well, how do you get in that leadership buy-in to come in and essentially lead that compliance culture, right? And to think about these things on a continuous basis, right? That's how you keep the bank safe. Obviously, if you are a relationship banker, you're almost become that first line of defense for your bank. And if you don't understand the client, then the compliance team behind you will know them even less. And I do believe that you need to go back and understand the basics. My team makes fun of me sometimes in that I like to quote Bear Bryant, and I've done this quite a few times, but he started every season as he was a former coach for University of Alabama football. And every season he would come and he'd grab a football and say, this is a football, right? We're starting with the basics from step one. And I think you need to be able to do that within your organization so that you can instill that culture of compliance. People all across the line understand what is needed to keep your institution safe.
What role they play. Great. So let's get into the opportunity, because there's a lot of opportunity here. So price to earning ratios for community financial institutions are at historic lows. Meanwhile, you have these correspondent banking relationships that are down 20% globally. So Sanjiv, you mentioned to me when we were preparing for the episode, the Reese's peanut butter moment here. Can you explain that analogy for the listeners a little bit?
Yeah, sure. I'm going to date myself a little bit here because I remember in the 1970s when these ads first came out for peanut butter cups, and they had this guy dressed up in a peanut butter jar costume and another guy dressed up looking like a candy bar. And they were just clumsily going along, and then they like smacked into each other. And suddenly you had chocolate on the peanut butter. You suddenly had peanut butter on the chocolate, and someone took a bite of it and they said, wow, this is really good. I think we sort of are at that moment here with banking in a way. Most community banks today, and you mentioned it, their PE ratios are down considerably. And that's because these banks basically have become one-trick ponies. They really have one key revenue stream, and that is making commercial real estate loans. And they've all talked about figuring out how to increase their fee-based income. They've all talked about how to actually stabilize and have a low-cost deposit system, but they haven't really come up with that many compelling ways to do so. At the same time, large banks, because of their fear of running afoul of AML rules, and really the way, I'm going to talk about this a little bit later, but the way they've gone about doing their due diligence have been cutting out small global correspondent banks and cutting them out of the equation altogether. And so they don't have access to the US dollar markets in the way they once did. And so the way I think about this is one of those is chocolate and one of those is peanut butter. And we're here to help you think about how you bring them together so that you can improve your fee-based income, you can improve and stabilize your deposit base, and you can ultimately drive higher returns on assets. And if you do that, you're going to start to see PE ratios bounce.
Steve, did you want to add to that?
Yeah, no, I think that once again, Riley, just like you guys mentioned, banks have been faced with very challenging times. And really, we're approaching 20 years of that, right? Ever since the financial crisis, banks have been dealt with very tight interest margins, created a very difficult time for community banks to succeed. And now, post-pandemic, we're coming into a point where I guess those interest rate margins are still pretty compressed, but now your cost of deposits have gone up. You might have a lot of books on your portfolio, a lot of loans on your portfolio that are just too high cost. And now your cost of deposits are also going up. And that's presenting a big problem for banks, right? What I think is the big opportunity out there is with fintechs, with correspondent banking, money transmission banking. These are lines of business that if you can figure out how to manage it, and that's where we come into play and try to help banks do that well, then you can help bring in low cost deposits, you can bring in some non-interest fee income, and you can generate new lines of business within your institution depending on what you want to focus on. And I've mentioned this, I think, in a previous podcast with you guys, right? That if you come in and you want to work with a fintech, you really got to figure out what line of business you want to work in, right? What are you trying to incentivize, right? If your cost of deposits are too high, then maybe you just want to focus on bringing lower cost deposits, right? Or if you're looking to just increase your non-interest fee income, then, what way do you want to do that, right? But the short of it is, I think there's a lot of great opportunities for mid-sized and small banks to be able to engage in this business in a very healthy, safe, and sound manner and bring profitability back into their institution.
So let's get specific around numbers. All right. So what's realistic for financial institution leaders listening in today, say in the 500 million to 5 billion asset size?
You want to take that one, Sanjiv?
Yeah, sure. I guess I think of it in these terms. Banks, they are running at around a 1% ROA at best. The smaller institutions are having a hard time beating that, which when you translate that to return on equity becomes really not very good and not the kind of thing that's going to drive much profitability. So what they really need to think about is trying to drive another 20 basis points of return on asset, depending on the size bank they are, which means probably something like fee income in the $5 million to $7 million range that they ought to be thinking about. Similarly, they need to figure out how to reduce their cost of deposits. And if they can get large, chunky deposits that come at a relatively low cost, they can bring down their cost of deposits by anywhere from 10 to 30%, just depending on how much of that they choose to do. I think there's a really important point in all of this, though, that a lot of banks lose sight of. And that is when you pursue something new, for it to be meaningful and to actually have a meaningful impact on your business, you kind of have to have a well-developed strategy that you're going to go all in on. You can't just say, I want to dabble in doing a little bit of something. Because if you just dabble, your earnings are dribbles. So what you really are trying to do is get to a point that you're building a new business that's safe for your shareholders, safe for your customers, that can drive fee income, that can lower your cost of deposits, and can be somewhat meaningful so that you can achieve some of the enhanced returns you want. The worst thing you can do is just try a bunch of little things and not really commit to any of them. And I think what we're here to try to help you think about, and I think can help you with a little bit, is actually building out and developing new business lines that have really a meaningful addressable market. And if there's a meaningful addressable market, it means you can actually consistently improve your earnings in the future. And that's really what we're hoping to help.
Yeah, and I think there are some very tangible examples out there of banks that have succeeded in these lines of business, right? There's a bank out in the Pacific Northwest, which is frankly a tiny bank in the grand scheme of things. A year ago, they were around 60 million in deposits. Now they're around 85 on book, right? They've got much more deposits off the balance sheet that they go and sweep away. But that is generating real tangible income for the bank and is a clear success for them, right? And we're seeing that being replicated with a bunch of other institutions that are, a lot of them are sub 500 million in assets, right? And 20 years ago, it was unimaginable to think, hey, as a small bank, I'm going to go and bank these fintechs out there, and thinking about what you got to do from a core systems perspective, or treasury management systems, or compliance teams and systems. But now there's much better tools available for these banks. There's a lot more knowledge into how to handle this and do it correctly. And I think that banks are, and financial institutions overall, are at the crossroads right now of being able to engage in something in a safe and sound manner with a lot more knowledge up front than there was in the past. And that just leads to better outcomes at the end of the day.
Wow. All right. So, Steve, I want to make the connection between, if you choose to go down the route of banking fintech, you could bank correspondents as well, right?
Yes, that's right. That's right. And I think I just mentioned a little bit about that earlier as well. But the challenges around correspondent banking really boil down to understanding who you're processing this payment for, right? Because when you're processing a payment for a foreign bank, you're doing a payment not just for them, but you're doing it for their customer, right? That John Doe, whoever they are. But when you think about it, that's the same challenge that you have with a fintech, right? Except that with a fintech, depending on how you structure it, you might have a sponsorship program, right? Where, okay, that fintech's customer becomes your customer. So now you've got full transparency and clarity around them. But if you have the tools available to you to be able to obtain that data, then you can reutilize those similar tools and apply that concept to correspondent banking. And now what you've done is you've tackled one of the biggest problems that regulators and examiners have been pushing for over the last 20 years. Now you've got that transparency as to, okay, who am I actually making this payment for? That's one of our main focuses with our company, is just giving banks those tools and having that KYCC first approach, right? And we're firm believers that if you know your client's customer, that KYCC, then you've taken a huge leap forward in understanding that transaction and having a better understanding as to, okay, is this really suspicious activity or not? Is this something I need to report or stop?
Great. So I want to switch gears a little bit here. So, Sanjiv, institutions often see the opportunity, hear about it, but they're fearing the compliance and the risk management lift. And you've called the traditional approach derivative compliance, right? So can you break that down a little bit? Relying on another institution's controls versus transactional verification creates these blind spots, is what you've said. So essentially in depository only relationships. But examiners now expect banks to see the parties and purpose per transaction, right? Not just trust upstream checks.
Yeah, and I think this is true whether you're talking about fintechs or you're talking about correspondent banks. The way banks have traditionally approached any kind of due diligence is that they focus on their customer. So they will do a bunch of analysis on their customer. In this case, the customer for the bank is the correspondent bank, the overseas bank, or it's the fintech company. But in both instances, those two kinds of organizations are doing transactions on behalf of somebody else. Right? They are actually, their customer is the one that's transacting rather than it being the correspondent bank themselves. They're doing it for someone else. But all of the analysis that the bank has done has really been looking at that correspondent bank or looking at that fintech and saying, what kind of controls did they have in place to make sure nothing goes wrong? And so their entire program is predicated on analysis that's once removed from the underlying transaction. Now, there's nothing wrong with doing that kind of analysis, and you should continue to do that kind of analysis. But here's the problem. The minute a single transaction gets through that was where there was something wrong, the minute you have that hole, you now call to question the entire program. Because you ask yourself, if that bank didn't catch that issue, why didn't they catch it? Do they have the controls in place that we thought they did? Can we trust any of the activity coming from them anymore? And so what we believe very strongly is that is really derivative compliance. What we want people to get to is a place to say, rather than actually just figuring out who the beneficial owners are for the bank or for the fintech, what if I knew who the beneficial owners were for the originator of the transaction? What if I knew the true purpose of that original transaction? What if I'd validated that the signer on that transaction up front was allowed to sign on their behalf? In other words, the kind of compliance that we would normally expect to do for our customers, what if we had the ability to have that compliance done for the originator of the transaction? If we did that, and there was an issue with an individual transaction that we processed and we caught it, we wouldn't have to throw out the entire system. We could keep doing work with them and we could still work out and manage their transactions that weren't as effectively underwritten as maybe we would like. And I think what we're trying to get people to understand is that the best systems are the ones where you can actually look at the specific transaction happening and make an assessment on the risk on that particular. That's what we really do. What I think the entire industry today is reliant on is someone else just looking at their part and then hoping that in the ether, using a bunch of analytics, you can figure out if something looks unusual. You only have to do that if you don't actually understand what's happening at the specific transactional. And so for me, this is KYCC is basically doing all of the verifications that we currently do for the correspondent bank, but doing it for the correspondent bank's customer. And that to me is a huge difference.
I was talking a little bit about false positives when it came to alerts earlier. Steve, I'd like to ask you, why do you think legacy monitoring tools produce alert clutter, say?
Yeah, well, it just becomes a problem of lack of information, especially when it comes to these businesses with fintech banking or correspondent banking, transmission banking. A lot of times these systems are set up just such that you're only reviewing information on either your client level. If you do get the client's customer level, all you're getting is name and addresses, right? You're not really getting more information as to who these underlying parties are. So overall, that creates a lack of context for your systems to know, okay, is this really the same person making the sanctions list, right? The most common alert out there is going to be your sanctions alerts, right? Your OFAC alerts, your specially designated the nationals alerts, right? So when you have that alert pop up, then what ends up happening is, okay, you have to go and review, okay, is this John Doe the same John Doe who's in Venezuela, as an example, right? So you have to go and obtain that date of birth information or whatever ID information to be able to figure out it's the same person. Now, if you have that information up front, all within your own system, then you can hopefully feed that into your transaction monitoring system. And I know there's some limitations of some systems out there to be able to absorb that kind of information or roll things out, but most modern systems are good enough today to be able to quickly make a determination as to, okay, is this the same person or not, so long as you have sufficient information. Now, banks have gotten much better over the last 10 years. Really, you saw that trend in the mid, 2010s, where some of the big banks started talking about big data, right? And they started standardizing their data, started trying to move away from all those silos. And then from that, you started seeing some of those mid-sized banks get better around that. So now I think we're in a position where there is better information out there that banks can use. And conversely, that means those transaction monitoring systems have now adapted to be able to digest that kind of information better and more freely. It's just a matter of, okay, everyone's got this data, right? Everyone's got them within their own organizations, right? If you're doing correspondent banking, that foreign bank has all this information on your underlying customers. The question is, can you obtain that data and push that through your own transaction monitoring systems to be able to go ahead and reduce those false positives, right? And it frankly, it's a big problem, right? It's a big problem. It leads to a huge increase in compliance costs, and it just creates what I think is a huge distraction, right? Because it means you have compliance personnel that are more focused on just trying to clear alerts than truly analyzing a transaction. And if you're trying to go through a big backlog of alerts, that really just means that you're spending less time reviewing a transaction and understanding it, and potentially the wrong kind of transaction could pass through you.
And here's how I think about that, Elyssa. Like, if you think about it today, we as banks are required to do a ton of upfront KYC on any customer that we onboard, which is great. But when a transaction takes place, we know what we've done. We don't know what the other bank has done. We don't have any visibility to what the other bank has done. So we're pretty much just reliant on what you can get from public databases, from our own screening systems, all that kind of stuff. Now, imagine you had a system where everybody shared all the information that they had done on the companies that they did due diligence, right? So instead of me just relying on public databases, I could actually go in and look and see what the originating bank, the analysis that they had done on who the company was that was sending that wire in the first place. If you did that, everyone would have access to so much more information, and everyone would, presumably with better information, could make better decisions. One of the reasons we've had to become so much more sophisticated about analytics and trying to do this is because we're doing it with only being able to see one side of the transaction. We don't really get to see what's happening on the other side. And a lot of people are going to spend billions of dollars using AI to try to solve it by just looking at half the information. What we're saying is that's one way to do it, but actually a better way to do it would be to be able to see both sides of it. And if you could see both sides of that transaction, you could see all of the due diligence that we've done on our customer. You could effectively see the most critical due diligence that the other bank has done on their customer or the other fintech has done on their customer, and then could make a determination, use all the analytics, use all of your knowledge to really understand whether that transaction makes sense and you should let it pass through. You'd come up with much better outcomes. You'd reduce a lot of those false positives. And more importantly, you would reduce the incidence of money laundering and terrorist financing, which, let's not forget, that's where this all started.
No.
So how do we do it, Sanjiv? Does that exist out there?
I think historically it didn't. And you needed to have people who came up with ideas to actually solve that problem. And what it really means is, I think of us as we're like the next door of compliance. We had to create a community where you could see both sides of the transaction. And that's really what Stephen's been doing with his companies. And I'll let him talk about that because he does it so much more articulately than I can. But the general idea is that we have clients in Latin America where we are requiring that they give us information about any company that they wish to have a wire transmitted to the US that we think is important to make an assessment on whether we think that we trust that company. We want signature cards, we want photo IDs, we want all of the stuff. We do all the checks that you would imagine that we would do on that particular client. We then want to know the purpose of the transaction when they're sending it. We want to see invoices. We want to see all kinds of stuff. And we have our own team of specialists who are really good at compliance, who are making those evaluations day to day. It's only once we've done that, do we then send that to a bank in the US and we let them know, we think this transaction is good, go ahead and process it. All that work is done up front because we know about who our customer's customer is. Our customer in this case, of course, is the bank. Our customer's customer is the initiator of the transaction. So I think it can be done today. It couldn't be done before because you didn't have the technology platforms in order to do it. But it is the kind of thing that is a completely new way of thinking about the problem that Stephen.
Yeah, no, and I think at the crux of it is going back to culture compliance, right? Is the culture that we're trying to push for is taking a more proactive approach to these challenges than a reactive one, right? Today, most banks they're going in and they're doing their transaction monitoring, and outside of countering fraud, which is real time, everything else are really looking backwards on, right? They're looking to say, okay, what happened in the last 30 days, 90 days? You're looking at those trends, and then they're asking for information on the transaction or information on the party or counterparty. Now, what we're trying to say and what we're pushing for and what we've been very successful at doing with our clients and partner banks and doing is taking a proactive approach of let's capture all this data up front. Let's ask the right questions when we're processing this transaction while everyone's got this information nice and fresh in their minds, right? And we're able to document that within the way we do it is within the payment itself, as well as within these KYCC profiles. But now we've created this auditable log, right? That we can come in and say, okay, I can pull up a transaction from 3 years ago and say, hey, look, what was this transaction for? Oh, okay, there was a purchasing, I don't know, 10 vehicles that they were going to import into their country. And here are the invoices, right? And then here's all the information we have on these parties, right? Versus having to go back and request that information from a client or your client's customer, even worst case scenario, to see if they can gather that documentation up. So taking that more proactive approach, I think just really allows banks to, and financial institutions to, in the long term, just have a healthier overall program and be able to stand up to regulatory scrutiny, which, as we know, just year after year, I mean, we might have had a little bit of a pause right now, but the overall trend is regulatory wise, things are getting tougher, right? And the expectations get higher and higher.
So institutions are listening to this and they're like, okay, we need all of this data. We don't currently have the technology for that, but we're hearing that there is technology for that. But I think what they're probably feeling when they think about new systems, new technology, is this kind of jump to, oh no, this is going to be a core replacement nightmare. Steve, what do you think the real story is with adopting new technology that's going to allow them to take on these opportunities and gather all
Yeah,
that
I
data?
mean, there are tons of different solutions out there, right? And obviously, some of them do require to make some huge investments and changes within connections with your core system. But there are some companies out there with some really interesting technology, and I'd like to include us in that list, right? Where we've moved away from saying, hey, look, like we're going to come in and, I don't know, do a big overhaul of your core system or ask a lot from your core. But instead, we're trying to say is, okay, let's come in and let's figure out what APIs we connect to and just leave your core and let your core do what it does best, right? Which is keeping track of accounts, those transactions, and let us deal with almost like in parallel as a sidecar, right? Be able to delve into transactions, or actually when it comes to these fintech banking, right? Our system is able to create accounts and sub accounts and do all the sub ledgering and then just feed into your core system end of day updates, right? If you need to, with the balances and whatnot. But there's no need for a rip and replace, right? What we are doing now is we are able to create these platforms that run in parallel and don't take as huge of investment as it used to be. Frankly, I know I've worked with some banks as a consultant before, and also we've got some partners of ours with Avalo that say, hey, look, we'll connect with you and be very little cost or no cost, and they're able to focus more on a SaaS business model because these API connections make it quite affordable for these new systems to be able to connect to this core system. So long as your core system does have those APIs available. There's a ginormous asterisk there as to situations in which this could be successful or not and keep it low cost. But overall, at least our philosophy, right, is we want to disrupt inefficiencies and not your operations. And in order to be able to do that is we want to be able to connect to some of the existing infrastructure and really just push things on the margins as need be.
Yeah, and I would challenge anyone out there to think about the amount of money that they would have to invest in technology if they wanted to create robust treasury management products for their clients. The amount of money they'd have to spend on their ACH systems, on having a really powerful wire platform, for having better information reporting, to have web-based access as well as mobile access that's anything comparable to any of the larger banks. It is a dirty little secret. None of them can do it. It doesn't matter what technology company they're partnering with. Everyone who goes out there and invests in a treasury management platform to compete with larger institutions falls short. They're never as good. And so if your pitch is to clients, stay with us because we have something that's almost as good as what you could get if you went to someone else, and that's where you're deciding to invest all your money, you can really ask yourself about really whether that's money well spent. What we're trying to do here is say, this is a totally different business than you're in and that most other people are in. And it's the kind of business that the systems to manage it, particularly to manage the risk, sit outside of your core platform. but we'll give you all kinds of reporting that you need that you can either feed into your core platforms through APIs, or you can have sit outside of your core platforms if that works for you as well. And you can really develop and grow this business on a standalone basis without massive capital investment. And I think that distinction is a huge one. The platform sits outside of what you're doing, but with whatever connectivity that you think you need on a day-to-day basis to make your internal process more efficient. But you don't have to actually connect much at all. And so by doing that, what we're enabling is fee income without massive investment.
Now, this is a good transition into this next question, and I'll start with you, Steve. So, where should the listeners start? So, say for a $2 billion bank CEO listening right now, where do they start Monday morning around investigating this discovery phase on fintech, possible correspondent banking? Where do they start?
Yeah, I think first you need to define what you want to accomplish, right? Like I mentioned earlier, you want to figure out, okay, do I need to lower my cost of deposits? Do I need to increase my non-interest fee income? Or am I trying to just increase my margins? Whatever it is, figure out what you're trying to solve for. And I would say you want to start small, but prove fast this business line, right? That's really the philosophy around Silicon Valley, right? It's just come in and figure out real quickly what you want to do and figure out, okay, what's what they call an MVP, right? A minimum viable product to get to market. And I think having this mindset as a bank might be a little bit difficult at first, right? But a lot of times you're selling some of the products you already have existing within your own organization. It's just a matter of, okay, maybe I need to go out and have some additional tools to be able to service maybe a fintech or correspondent bank, which is what we've been talking about. So I think that if you do want to engage in with a fintech, obviously we've been talking mostly about payments, right? But there are fintechs out there that do buy now, pay later, right? Which is small loans. You got some fintechs out there that are really good with larger personal loan originations or whatever it is. So you got to figure out, okay, what are our core competencies as a bank, right? And really, where do you want to focus on, right? If you've got a good wire team and a treasury management team already, then it might make sense to go out and focus on fintechs and banks that, hey, need payment services, right? So that's where I think as an executive, you need to be thinking about what are you trying to incentivize and what are you trying to grow within your institution. And once you're able to define that, then you can come in and set your own parameters for success, right? It's what KPIs and KRIs do I need to be tracking to ensure that I can, if I want to make a review after 6 months to see if this is going to be successful or not, and going back to this idea of start small, improve it fast, then you better have well-defined metrics to be able to track and say, okay, how am I going to define this being successful?
Yeah, I think that's right. I would go, sorry, Elizabeth, I would even go a step further. I think it's really important if you're going to pursue something like this, whether it's through the fintech arena or through correspondent banking arena, you have to have in your mind within 3 years how big you want this business to be. And then you have to ask yourself, is that number meaningful enough that I'm willing to put in the effort to do it? If your objective here is to grow your fee income by 10%, can I get at least 50% of my fee income growth over the next 3 years from this initiative? I would say if you don't think you can, I probably wouldn't waste my time with it. If you see it, though, as something that you think can be a meaningful component of your fee income going forward, by all means do it. Same thing is true with deposits. If you feel like you want to bring down your cost of deposits by a certain amount, which means in your community bank, you need another 200 million deposits from this initiative. Can I get to 200 million in deposits from this initiative over the next 3 years? And what kind of activity and volume would I have to be willing to accept and run through my institution for that to happen? You need to set those parameters up front, put the business case together and get your board to review it and accept it. You do those things, then you can do exactly what Stephen said, which is pilot, see if it works, see what's wrong with it, but get everybody on board then to say, we've made this work. We're now going to grow it so has some meaningful impact on our financials. And I think if you do that, you'll have a much more successful initiative, frankly, with what we're talking about here or any new business initiative that you decide to take on. The worst thing that leaders do is they're so afraid to go that they start small and they never scale up. But the problem is if you never scale up, you never actually generate any of the economics that made the effort worthwhile in the first place.
So you had mentioned getting your board on board and things like that, getting everybody, all the stakeholders together. So who would you guys say needs to be in the room when this is happening?
These, at the end of the day, these are high risk businesses, right? And that means you need to have your compliance team on board. You got to have your payment operations teams, your obviously executive management, and your board, right? Time and time again, I spend a lot of time reviewing C&Ds, cease and desist reports, and consent orders. And a lot of times when banks get into trouble, one of the first things they mention is that either senior management or even worse yet, the board is unaware that this business is happening, or they just get very little information going up to them to let them know if this is a successful program and a healthy program and if it's being managed correctly, right? And by manage, we're talking specifically about the risk management aspects of it. So you want to make sure that you are deliberate around this business. And once again, that you've got the right KPIs and KRIs to be able to accurately measure the success of the program. But going back to your question, I think having your compliance team, I think that's where you have to start, right? You have to have your compliance team. If they're not on board, very difficult to move forward. And you have to have your executive management have the buy-in as well. And I think Sanjiv had a great point there that, yeah, a lot of banks will come in and they'll start pilots, but they're very hesitant to grow it. And then all of a sudden now what you have is a very large liability on your books. If you're not going to grow it, you might as well just kill it, right? Because you do need to go and water your plant, right? Because there are expenses that are associated with this business. And if you don't take that into account and you don't grow the business, then I've seen some banks start cutting corners, right? And that's the last thing you ever want to do.
Yeah, just to follow on that a little bit, one of the things that I've observed is often you may get executive sponsorship, but you don't necessarily get the compliance people buying into what you're trying to do. And now you're going to have a drag on what you're trying to accomplish and nothing will ever happen. And I think one of the more effective ways to deal with this, particularly at a community bank level or at a smaller institution, is to bring together three of these people and have them collectively work on the business plan that you're ultimately going to present to the board. If the line person does it on their own and they haven't done it, it's a little bit like if you want to do a new loan program. You never tend to see the line people talk about, let's go do equipment finance. And they don't get the credit people involved in saying why they're okay with doing equipment finance. The same thing is true here. If you think you're going to go do more correspondent banking and or fintech banking, you need to make sure that the risk people involved in that within your organization have embraced this and are going to dedicate the resources to help make it a real success. And I think if you get everyone's buy-in up front, it also means you're listening to their concerns up front. And if you listen to their concerns up front, you will see the benefit and the value of having the kind of transactional-based compliance that we're talking.
Bring everybody. Especially the compliance people. Bring them all.
Bring them and bring the executives. They need to make
their friends.
They need to make a lot of money. They need to make sure they know they can make a lot of money doing this. Yeah.
They'll like that. So you guys have mentioned these are high risk relationships, right? So a lot of financial institutions may work with fintechs for, say, deposit growth, but you're still seeing hesitation on the correspondent banking side. So Steve, we'll start with you. Do you see that as like a justified fear? Why do you think that is?
No, like once again, right? If you've got the tools necessary to bank a fintech, specifically or especially if you are banking fintech that is focused on payments, then you have the tools available to go ahead and deal with a foreign correspondent relationship. Now, you might have a few complexities on there when it comes to, okay, now I've got maybe a foreign entity or some foreign persons, right? But so long as we're able to capture the KYC information, right? And once again, I'm a big, huge believer in knowing your client's customer and having a KYCC approach. If we're able to obtain that information, then now you have a much better understanding as to not just the parties, but how does this party connect to this payment itself, right? And that leads to you having a better understanding of the payment itself. So I don't think it's too far of a step to go from one to the other. There are some nuances and differences there that you do have to take into effect, right? Or if you got a fintech program, you might just be focused on just domestic clients. And obviously there's a lot of data that's available on domestic persons, right? To be able to verify them, starting with the social security numbers and credit reports and whatnot, that allows you to have a better understanding as to who that person is. That might not be available in a correspondent banking scenario. But at the same time, if you've got the tools to be able to acquire some of this information that your client bank has on their own customer, then it's just a matter of, okay, how can I obtain that in an efficient manner, right? And how can I convert that data into information and knowledge for my institution?
Yeah, and I think most banks that have started thinking about introducing fintech programs have recognized that their programs are going to extend beyond providing services to companies that are in their footprint. They basically accepted the idea that they are going to target an industry vertical as opposed to target a geographically bound set of businesses. Once they do that, and I think they do have to make that shift in their thinking and decide that's something they think is worthwhile to do. And I think they all think it's worthwhile to do today. A lot of them feel it's worthwhile to do because they do have such a problem with generating more fee income, diversifying their revenue streams, getting better deposit flows. Once they recognize that, now it's understandable. Everyone's heard about fintechs, right? It's in the news every day. Correspondent banks are arcane. What's a correspondent bank? I don't even know what a correspondent bank is, let alone, is there actually a business here that I should be doing? Wait, what am I going to be doing? So I think we actually find that companies that start to think about doing programs for fintechs suddenly can see the similarities, frankly, see the risks as not being all that different. And the solutions to address the risks are actually the kind of solutions that we provide. And so to the extent that they understand those risks, see the opportunity, and then can pursue those opportunities to grow their broader platforms, because they can lump those businesses together, if you will, when they present what they're doing. And if you say, if you're banking a fintech, you should be able to bank a correspondent bank, an international correspondent bank. It takes a minute for people to make the connection. Yes, there are nuances and there are differences, but there are differences and nuances between fintechs as well. Once you understand that piece and you can see that we can support it, you can get to a point where you get enough scale so that you can generate the kind of returns that you were hoping.
Exciting stuff. So we kind of started talking about turning compliance from cost center to a revenue engine. Closing final takeaways from you two. Sanjiv, did you want to go first?
Yeah, I think hopefully one of the messages that you're hearing here is that when something is hard to do and a lot of people haven't figured out how to do it, and you do figure out how to do it, there's a huge opportunity for you. And so I don't recommend people try to build this on their own, but I do recommend that if they work with organizations like ours, companies like ours, there are mechanisms for them to get the first mover advantage to really drive these businesses first. And it's like anything else. If you start to do it and you build more knowledge, you just are always ahead of everybody else. And for us, we think that for banks who are looking to grow revenue, particularly fee-based revenue in ways they hadn't imagined before, this is one of the few avenues left that isn't completely saturated by the really large banks. And so for us to help you do that and for you to then go ahead and figure out how to make that compelling for your organization, I think is a really great opportunity.
Right. Steve, how about you? Any final takeaways?
Yeah, no, I think, well, the banks that are going to be successful tomorrow are the ones that are making the investments today, right? And are really starting to think about these things and looking to see, okay, how can I diversify my revenue streams? How can I diversify my deposit base? And obviously, everyone's thinking about these costs that are continuing to increase, but you're not going to be able to solve that with just doing the same thing you have been doing for the last 20 years. Unfortunately, a lot of banks, a lot of great financial institutions have been around for some of them over a century, just doing banking or community, dealing with just small loans. And that's been successful up until now. And we're seeing a huge disruption around this. Obviously, we've seen a big consolidation because of this around banks as well. And I think that the technology is out there, and those costs of technology have been going down, and that information is so readily available today that I think banks are foolish not to at least consider if going to these lines of business might be a way for them to diversify themselves and succeed in the future and look beyond just the boundaries of businesses where they've been engaged in before. So, look, I think they have to look into, at the very least, like I said, consider to make these investments, see if that makes sense for them, and see, okay, how can this help them achieve their goals of, if they need to, once again, diversify their deposit base or income streams or whatever it is, right? But I think this is one that can really help banks succeed in the future.
Great. Thank you, guys. So the message for today's episode, crystal clear, the tools you need to unlock fintech and correspondent banking partnerships. Same program, broader opportunity. This isn't about choosing between growth and compliance, right? It's about making compliance your competitive edge. So we will be sharing a resource, a recent article from Sanjiv. We'll link those in the show notes for all of you today. And to all the listeners, thank you again for joining us. Thanks again to my guests. I hope you all have a wonderful day. Take care.